Well, good afternoon. Happy Friday, April 12th. Mark Milam here. Let's get right to it. Woo! What a week we had economically here in the United States. Stock market and bond market both taking it on the chin Wednesday as the consumer price index came in hotter than expected. Yes, 0.1% higher than consensus estimates, but that 0.1% made all the difference. Let me show you what I'm talking about in the world of mortgage-backed securities. This was Wednesday, April the 10th, the single biggest sell-off in the mortgage-backed security space since October of 2022. Worst day we've had in mortgage since October of 2022. Saw rates worsen to the tune of roughly 1/4 percentage point on the day. Yesterday with PPI actually coming in under consensus estimates, we still sold off a little bit more, bouncing back a little bit today to close out the week. Maybe that's a little bit of Masters Friday optimism. So this has really been a tale of no one, and when I say no one, I mean no one really getting it right when it comes to understanding where our economy is headed. Whether you're following an economist, people in the mortgage industry space, or the housing industry, no prediction has been accurate as it pertains to the trajectory of inflation and certainly the trajectory of interest rates now that we're back to November of 2023 levels when it comes to mortgage interest rates. And why is this? Why is this so challenging to understand? And I think there's a fundamental reality that we have to embrace, that the world has changed since COVID, right? And the COVID has actually changed our economy, and you only need to look so far as a couple of different economic reports to understand that. First of all is this one right here. This is the U.S. personal savings rate. And you can see that since COVID, since the incredibly high savings rate that we had during the pandemic when you couldn't spend any money and the government was sending you money, we're not really saving hardly anything anymore here. We're below pre-pandemic levels in terms of our savings rate. That's one thing to note. And as if we're saving less, what are we doing? Well, we're spending more. Our personal consumption expenditures as a percentage of GDP far higher than they were pre-pandemic. We go all the way back through the decade of the 2010s. We are far outpacing our savings rate, our spending rate here in America. And that kind of coincides with the lower savings rate, of course, right? And then this is the U.S. here surging as compared to all of the other major economies out there in the world. The United States GDP forecast for 2024 year over year is surging, while all of these other countries are slowing down, right? Slowing down from 2023 levels. And really, what does this all mean and why? Is this just, we're coming out of the pandemic and we're ready to spend more money and we've realized the pandemic made us realize life is short and we should enjoy it? Or what exactly is behind this phenomenon that we're experiencing in America? That's a great question and one that's not easily answered. But when you look at this data, you can understand why certain models just don't make sense anymore. Like the yield curve inversion, for instance, that it was typical that a yield curve inversion, meaning short-term maturities are higher yield than longer-term maturities, that was a predictor of recession. Well, we have been in the longest yield curve inversion in the history of the United States as it stands right now today, and there is no recession anywhere on the horizon. In fact, inflation is ticking up. It is not coming down. So that particular indicator or leading indicator of economic activity is not really a reliable one. And matter of fact, a lot of leading economic indicators are turning out to be not so reliable. So as long as the consumer remains this resilient in terms of their spending and is not really saving, inflation is going to remain sticky at that 3 to 4% range. And we're going to have these unexpected days like we had this past week where we see mortgage rates take it on the chin. That in and of itself provides brand new context for the year of 2024. The year that, listen, 90 days ago, economists were saying that the Fed was going to cut the Fed funds rate 6 times in 2024. You wake up this morning and you hear what economists have to say, and they say maybe the Fed will be cutting once or twice. Or if you're Larry Summers, you're going to say that the Fed might even hike interest rates in 2024. But certainly there are no cuts coming in the first half of this calendar year. If I can be of any service to you over the weekend, don't hesitate to reach out, mark.milam@highlandmtg.com. Have a good weekend.